Hello, welcome everyone, and thank you for joining us today. My name is Nick Barker, and today I'm talking to Onfido CEO and co-founder Husayn Kassai about a concept that's perhaps often spoken about and slightly less often executed, disruptive innovation. In recent years, it's brought about vast transformation in how we get from A to B, in how we consume entertainment, and its effects in the financial sector are now starting to be seen. Today, we'll be examining exactly what disruptive innovation means and perhaps discussing how we can expect to see its change in coming years. So, over to someone who may know a little more about disruptive innovation than myself. Husayn, thank you very much for joining me today.
It's good to be on.
So, it feels like a good jumping off point for this discussion. Kind of by the textbook definition, just what is disruptive innovation?
There are many different ways of thinking about it, and broadly speaking, in my mind, there's something that has to be new and in some ways not have happened in the past, and at the same time, fundamentally changing the way incumbents or the status quo operates. So Clay Christensen, the way he defines it is the process by which a new product or service takes roots, often in a small segment of a potential customer base, and then rapidly becomes mainstream. So that over time, when it becomes mainstream, it makes the incumbent less relevant.
Mm-hmm. Am I right in thinking that kind of the process by which that's achieved, perhaps more traditionally than in modern times, has been around coming in with kind of a low-cost alternative and starting from there?
It often can be. Cost typically is a major factor. The fact that we have technologies enabling digitalization of more and more things, that in itself has reduced costs, specifically marginal cost. So you produce 100 units and then the 101st unit, the marginal cost of creating that, if it's digital, i.e. zeros and ones, you have a negligible server cost, and essentially that doesn't make much difference whether you produce 100 or you produce 100,000. If it's digital, then there's no marginal cost as such. So when typically, if an incumbent exists and an innovative provider is able to produce a service at a lower cost, they're potentially able to charge less, and as a result, that would be a typical example of them coming in at the bottom of the market and then building their way up and eventually offering all the services that the incumbent historically has been able to, but unbundling what the incumbent has done, offering one or two of the services, maybe even slightly inferior to what an incumbent does initially, but finding some attraction amongst a small segment of the customer base, building on that, and over time, rebundling all the services that incumbents may offer, and ultimately becoming a serious competitor to the incumbents.
That's really interesting. I suppose to link that kind of and loop it back within financial services, and I can imagine this will most likely link back to your point around digitalization there and digital technology. How is financial technology being disrupted right now?
In a number of ways. Historically, if you consider what it would have taken for a business to become a financial service provider, the cost of setting up would have been high. The distribution channel likely would have not been straightforward, i.e. would have taken a lot of time and a lot of investment. But what's happened, especially over the last 5 to 10 years, is first of all, the cost of setting up a business is significantly reduced. You can become a regulated business and offer financial services in a much more straightforward way. You can just get a license for payments or just for remittance, or you don't have to, go for the whole banking license. You can actually start pretty small. And because of all the other services and tools that are now available quite easily, you may have to spend, let's call it $1,000 a month to gain access to the same productive services and tool sets that would typically cost a mainstream bank maybe even $1 million a month. If you include the server costs and productivity tools and all these things that we can subscribe to on often SaaS-based platforms, we have, as a financial service, we have the opportunity to gain access to all these tools at a fraction of the cost that we were historically having to pay. And that enables, naturally, to lower the cost of providing services to customers and being able to move a lot faster.
Mm-hmm. So I suppose it feels like potentially some institutions may be at a bit of a natural advantage. I suppose having kind of challenger banks coming through as digital natives, having that infrastructure there from day one, kind of puts them in a naturally good position versus perhaps their legacy competitors who have to digitally transform to almost disrupt again and start to win back what they're losing within the market?
In many ways, and it operates on two fronts. One is the supply side, the technology side, meaning technological building blocks now exist to be able to do it all digitally and not to have expensive, be it offline or basically institutional infrastructure that historically would have cost a lot. And so you can have it all digital. The building blocks include smartphone, obviously we're in digital identity verification, accessibility and everything else. Means lower costs, offering services and being able to penetrate a much greater proportion of the market. But you also have to have the demand side. You have to have customers who care about those things. And over the last 5 to 10 years, the customer value in financial services has also changed in pretty fundamental ways. So if you look at when the first smartphones came out 10 years ago, and you look at the smartphone generation now, let's call it 20 to 35-year-olds. From the age of 10, a lot were exposed to new age sites and apps. So anything from Facebook, MySpace, and the digital experience started quite early. Hence, the user experience is kind of native to a lot of the smartphone generation. So that is what they value, and that's what's normal to them. And whereas the mainstream banks, their customers may care about a face-to-face interaction in a bank branch and the things of that nature, availability, is it open on a Saturday or not, for instance. The smartphone generation, what they care about the most is how cool is the app, how easy is it to use, can I download it on my phone? And so you can see it's kind of a shift in mindset as to what is valued. And sometimes what one side wants, the other side probably doesn't. So the other side, more mainstream bank customers may want a physical in-branch experience at times. They may look at how old is this bank and how much can I trust it because its assets are worth $1 billion or more. Whereas the new smartphone customers, they probably don't care, nor do they want to care about how old the bank is or how established it may seem. What they associate trust is how easy is it to use, how transparent are they when they publish results online and things of that nature. And so there's also this demand side that comes with it, so that technology has enabled a service to be offered to this new customer base, you could call it. And that has proven to be popular enough so that's over time building into the mainstream, because naturally if it's the younger demographic, over time as they age, they will eventually become the mainstream.
It's really interesting, kind of the shift in priorities from perhaps security and rating that against the ease of user experience and getting into a service. I suppose could we perhaps look at a few examples of maybe institutions you think are doing that particularly well right now?
Absolutely. So on balance, I guess, as not necessarily a universal rule, but generally a rule, customers prefer a faster service, a lower cost one, and generally a better experience, a more convenient one. And so the digitalization can often speak to 1, 2, if not 3 of those things at once. So you can apply this to pretty much any industry and see that if these conditions hold and technology has enabled new service providers to come in and disrupt the incumbents, then they've been able to do well. But it's important to remember that the incumbent is in a tricky place because by definition, it is the innovator's dilemma that the incumbent is not able to react. Because if you are a mainstream bank, you have to remember that you may have 20 million customers that are used to having more offline or traditional experiences. So if you force digitalized experiences on them, they won't like that. And yet, how can you at the same time neglect this new growing customer base? So it's quite tricky. And so your question on how is that, what's the best reaction to that and what has happened, what are the mainstream banks doing? Some are not considering the future demographic needs and changes and what they're asking for. So that's not necessarily, in my view, like long-sighted. Others are doing what I think is the only option, which is continue to service the mainstream, because you can't forget your core base, and spin out offerings to cater to the new ones as well. So this is either buying an online bank to cater to the new needs, or essentially spinning up a new digital arm and so on. But ideally, being as flexible as possible so that over time, as all needs change, being able to quickly have the capability to adapt accordingly. And to do that, as a mainstream bank, you have to move away from legacy systems into newer ones. So some relatively few on balance, but some of the very large banks have now started, and a few have already made a lot of progress, changing the core infrastructure so that it can be a lot more capable of adapting to changing needs as technology enables new services to be offered.
I suppose kind of we've spoken about user experience quite a lot within that, and maybe the other half that I feel like I'm seeing maybe advertised to me more and more within finance is kind of personalization. I just wondered, could you talk to that a little bit?
Yeah. So what has the innovation be as far as the disruptors go, the challengers go? Again, there are different perspectives on it. If banking is a good example, because most people can relate to it, most people do have a bank account. And therefore, the first FinTech wave, in many ways, was a user experience one, where customers that they catered to, typically the smartphone generation, were more used to a better user experience, and therefore when they saw a service that is much more what they're used to and much more what they're comfortable with, they were able to register. Again, I'd like to think that identity verification has a key role in that, because if you can't have a good user experience and ask someone to go inside a bank branch and find a utility bill and try to get verified in person, you kind of need that to be digital and as smooth, and it aligns to the mission of that FinTech in being smooth and putting the customer experience at the heart of everything. So the user experience wave was in some ways the first one. The second wave is more likely to be FinTechs targeting the bottom of the pyramid. And this is where the cost component becomes more relevant, so that if you're a petal bank or a Tala doing microloans in emerging markets, given that you can now digitally offer these loans, you can offer a $10 loan and a $50 loan in a cost-effective way and a scalable way. So you have to remember that half the world's adult population are underbanked and unbanked, and therefore are not financially included. And a big part of that historically has been that they've not been identity included. So they didn't have a bank account to go and get verified to plug into the global economy, whereas now different building blocks, including what we do, helps anyone in the world, as long as they have a camera-enabled device and a government ID, be verified and sign up to, let's say, a Tala, and they can offer you a $10 loan. So the second wave is likely to be offering services to the subprime, or basically underbanked and unbanked across the world, a range of different services. And the third wave, it could happen in conjunction, is more likely to be moving towards personalized services based on your data, where consumers trust the platform and see benefit from it. So there are good examples of Credit Karma historically has been able to offer you preferential loans because they've got more data on you. Or Curve, I'm a fan of getting data, and over time, I'd expect they'd be able in a good position to offer you more personalized services. And these are some of the things that historically we've not been able to get from mainstream institutions. But the benefit of all innovation is that customers seem to like it a lot. And so the mainstream banks are looking to adopt and are looking to learn.
I think we've kind of touched on it a little bit within that, but kind of the role of technology is almost an enabler of disruptive innovation, which I feel like we know quite well coming from the identity verification space, which has been sped up massively through advancements within artificial intelligence and machine learning. I suppose that's happening elsewhere in finance. And I just wanted to talk about that a little bit, about tech as this kind of enabling factor.
Sure. It is. I think if we go back to the universal truths of customers anywhere in the world want service, if where relevant, where it's faster, more convenient, or better quality, lower cost, and so on. That's kind of always been the case. But in order to make that happen on the supply side, technology is a key means by which that can come about. Mm-hmm. So you can have business model innovation and other things, but on balance, it's technology. So the technological building blocks, if you look at our space that we know well, like identity proofing, verification, especially connecting your offline identity to the online world. In 2012, when we started, it was a unique period because that's when internet connectivity across the world increasingly became accessible. You had facial biometrics. It was basically proven that scientifically that machine learning powered facial biometrics can verify faces better than the human eye can at scale. And third, and probably the most important, is actually other technologies like smartphones. And that's when you may remember the iPhone came out with the focus feature. So, if you're holding a government ID, it can actually focus on it. So all these are necessary to be able to digitally take offline identities online. Then when you do that, that plays a material role in these FinTech services and trust marketplaces and other industries in offering a fully digital user convenient experience. So technological building blocks are continuously needed to pave the way for other services and tools to be built upon. In parallel, I guess one other key one that I missed is servers becoming accessible. Whether this is your AWS or others, we don't need a massive data center and like servers anymore. We can just plug in and use others and pay in a sort of without having a massive upfront cost, which makes it accessible and possible for a small company with relatively low upfront costs to become and operate in a truly global way. So all these factors, and you probably know well that machine learning especially is very server hungry. It needs a lot of processing power. So all these building blocks came together to enable us doing what we do, which is why timing is actually pretty important if you consider disruptive innovation. And typically quite a few building blocks need to come together to make it fully come to fruition. But it's inevitable, it's just a case of when.
Mm-hmm. I suppose it's almost to go back to kind of the processing power example that you pulled out there, kind of be an expert in your expertise. Don't be an expert in the technology that you need to power it. I suppose to move into maybe some more specific examples of late and kind of touching on perhaps blockchain and cryptocurrencies a little bit. Facebook's obviously started to or talked about moving into its own cryptocurrency, Libra. Has been met with, I think, some pretty firm resistance from different places. Why do you think they've ended up where they have within that journey?
So it is, as for where finance is headed, and how that's, I guess, relevant to Facebook. More and more of the big tech companies are looking at finance as a next thing to focus on work, and it's already essentially started. Some of the largest banks in the world, typically investment banks, are now coming into the space. It's already happened for a few decades that automotive, right? General Motors actually makes more money from the financing of cars than building them. So it's not a new thing. It's just financialization is typically where a lot of industries that can move into do, given there's return on investment and like part of the thesis on most strategic views. The question becomes, how is Libra different, and what have they done well and what could have gone better? What, maybe from my identity lens looking, I see Libra less as a payment or a digital currency platform. I see it as fundamentally an identity platform, so that you can't facilitate amongst 2 billion people a means for them to transact and send money to each other without knowing that they are who they claim to be. And this is their legal identity, not their social identity. So obviously Facebook historically has done a very good job. It's not just actually solved the problem of people sharing their social identity. LinkedIn has solved the problem of everyone being able to signal their professional identity. And naturally our focus is to be able to solve everyone's ability to prove their legal identity. That's your date of birth, name, address, it's government ID, facial biometrics, so that you're compliant if there's a financial transaction. And if something bad happens, a bad actor can be reported to law enforcement. You can't do that on someone's social media, right? Because it's just not secure. It's so easy with an email address for anyone to do that. And therefore, Libra has not yet been able to be a success because it's not cracked solving for the fundamental global identity infrastructure layer, which is what is needed. And then the rest are just the consequences, which the reason why the regulators are so interested, because they have a legitimate point in that if I'm a money launderer, what's stopping me sending you £20 on my Facebook Messenger or WhatsApp, right? And it's, how can you do that over 2 billion people without knowing that they are who they claim to be? So that's one thing. The second thing is the approach. And this is finance is in large part derived from trust. And you can't probably do it well without building a trusted ecosystem to begin with. So you have to solve for some of the connotations, at least as far as the regulators perceive, of digital currencies. And it's fine if it's stable coin, then it's fine if it's pegged and all that's good. But you really ought to be speaking with the regulators from the outset, not as an afterthought. This is not one of those things you want to move fast, break things, and then solve for later. It really doesn't work that way. However, I am optimistic because it is Facebook. It's got a distribution second to none. I maintain that this is not one of the projects where you can run fast and break things. And if there's one company in the world that can't really play around with personal identity right now, it's probably Facebook. So we've got you could say, a big task at hand, but they have their advantages. And whenever it is Facebook, right, if they're serious about something, they will make it happen. It'd be exciting for it to happen. That would be disruptive innovation.
I suppose, but for Facebook, kind of coming from this almost ubiquitous global place of, it's the one company almost everyone on the planet has probably heard of, such a large proportion of the world's population with an account, do they need to fix kind of the identity problem, I suppose, then, at both a regulatory level as well as kind of a legal identity level? Do they need to cover the globe at once? Or do you think they could launch in specific markets and keep it walled for a time?
As for like a go-to-market strategy, it's probably better if it's done in stealth mode locally, then scaled. That's not their approach has been so far. It's been the opposite: big bang announcements and partnerships, and then so much regulatory inquiries and I guess discovery that has kind of slowed it down. But although I guess I'm saying over time, maybe over a long period, there's something that can be done. But back to I guess the trust point, it would be disruptive innovation, because if 2 billion people in the world are able to transact using Facebook won't stop there. It's going to then go into other services and ultimately banking, right? And then it'd be hard for others to compete with that. Hence, you'd class that as disruptive innovation, because the marginal cost of adding a service to one of the 2 billion would be negligible for Facebook, because they're so large they can underwrite enrolling everyone into this ecosystem and then layering service after service on top. But the point around fundamentally understanding trust is an issue, and finance and trust. So there is a point around the fundamental core business model of Facebook is essentially to get as much data from you as possible, to then be able to profile you and then be able to advertise you. It's as a result, there's this tension. For example, if there's something politically incorrect that is posted and there is some grotesque image, for instance, they can't really block that as a core model, because those images get the most views, and that's what their business model is fundamentally driven on, is views and revenue. So you can't have such a head-to-head conflict on that, right? And people are already becoming a bit sensitive about Facebook having too much data on you. And now, if they want to know what's in my bank account and what's fine, that won't be an easy journey. So what we are doing is focusing around helping enable that trust layer by helping everyone become anonymous online where necessary, so that the financial service provider and others would know that you're over 18, you're male, this is your address, and whatever you are comfortable sharing with them. But you are anonymous to the big tech companies, and therefore it levels the playing field online a little bit more. And the crux of the test around trust and this fundamental issue is right now, it's political adverts. The question is, Twitter's banned it, Facebook, are you going to ban it or not? And the answer is no. So far it's no. So you can understand when it comes to finance, equally, it's going to be hard to build that trust with customers, which the fintechs have. They've been very transparent and they are mostly trusted. It's hard to see Facebook being trusted in that sense for finance. I trust it to find out my local event or whose birthday it is, or who's posted on someone's wall. I don't know if it would have the trust on finances unless it radically changes its approach and its business model.
I suppose it's tough because, as you say, it's kind of their business model. They're incentivized to kind of get more views, and it's easier to get more views by being
built into the company's value proposition.
Slightly towards that kind of extreme.
with
I
no
think
limits, right? Even if it means the political situation in the country
mm,
changes, that's what the loan limits is. Like, so be it.
yep.
We need to hit our revenue targets or growth targets, or whatever it is.
I suppose the one thing for me that Facebook's got going for it, which I don't think any other company's cracked. I have to say I'm not a crypto enthusiast, but I think one of the barriers to entry for me has been kind of the user experience and perhaps complexity of wallet systems.
Sure.
And if Facebook have the UX staffing to kind of beat that problem, then as you say, it kind of the one piece left is almost that brand trust of, do I want Facebook to be handling my finances?
Correct. The main advantage of digital and cryptocurrencies is the layer of not having a middleman and the speed and all the other benefits, but also it being anonymous. The current Libra infrastructure, despite the rhetoric, is centralized. Like, they store the keys. So you don't really get the privacy as one would hope. You don't get the security because of breach risks. And you essentially are tagging along not just a payment, but potentially all your other data that goes with it. So it runs counter to all those who actually have see the benefits of a decentralized currency or payment system. Again, it's not it's all solvable, but not in the current way that is being run.
Kind of in our conversations around Facebook, there we've spoken a lot about identity being at kind of the crux of the issue, and it feels like identity is something that I think the average person on the street is starting to take a lot more seriously, and it's intertwined with kind of privacy. It's moved much more into the forefront in the last 5 years. Big advertisers like Apple are now starting to almost sell privacy as a product that's embedded within their services. How has the significance of identity for you kind of changed over time? I feel like you're probably one of the best placed people to have observed.
I'm an observer like everyone else, but so I in my mind, identity has always been the key factor that has underpinned all trade, period. It's done in different ways. Historically, the legacy approach was to see someone face to face in a bank branch and onboard them. Then it was sort of centralized in a log and then digitized in a way like a credit bureau model would work. What we've done more recently is replicate that. So instead of you going in a bank branch, you just from home, you take out your phone or your computer and you take a photo of your ID, photo of your face, and so on. And so it is all about trust, and then you have trust brokers. So when I want to send a payment, you're a grocery store, I want to come and make a payment, I use my card. That is a trust broker. That is underwritten by Payment Rail, which is a trust broker. The bank that issued it is a trust broker, and the credit bureau that was checked is a trust broker. Whereas if I come and make a payment and then I'm able to digitally build that trust with you directly, these trust brokers are no longer needed. They're disintermediated essentially. And that is happening in places like China, where it's Ant Financial, WeChat, they offer these services and you're able to build trust using those platforms. They offer the key building blocks. One is security. They're relatively secure. They offer convenience, and it's be very, very convenient. Although you're rightfully saying people are becoming more conscious and aware of identity, it's still a niche and a small percentage. I think consumers don't care about, nor should they care about identity essentially. It's like, I don't care about payments as such. I just want to get my coffee off you and like walk out essentially. That's why the convenience point is so important. And thirdly, privacy. It is a small factor, but one that is with a very small fringe of people who care about it truly, or at least fully understand it. But that is rapidly growing, and hence privacy is so important. And obviously, the Chinese model, you have no privacy, and there are dangers, significant dangers with that. So your question around the significance and how it's changed, or how perception of identity has changed, for most businesses, I would argue, over the last 7 years that we've kind of continuously asked questions, it has definitely gone from a tick box compliance, we need to get this done. As the fraud has evolved and it become a lot more effective, it's been seen as a security fraud deterrent tool to onboard people, ensuring at the outset they are who they claim to be and therefore reduce the likelihood of risk. And now it's evolving into being seen as the strategic significance of a company. So it's no longer a cost or a tick to be, I guess, actioned. It's now solving for a strong, convenient, secure, robust identity solution. Means as a business we're able to do 10x what we even thought was possible. In my mind, once you solve as a business, now we're talking about financial services, as a financial service business, once you solve for identifying users who they claim to be and then be able to authenticate them over time, the rest is just finances and numbers and basically accounting and a UX layer. So identity like underpins the whole thing, and therefore the strategic value of that is becoming a lot more real for not just businesses, but over time it will be for consumers too.
So is it in terms of getting to a place where a consumer might choose a merchant based on their security protocol? I suppose in how PayPal has semi-built their business on, I might be more likely to choose a merchant because I trust the way that PayPal will handle my payment details more carefully.
That is part of it. In a very long term, consumers, if they got 4 or 5 banks to go to, they'll consider who is respecting my privacy, who can I access most easily, and who can I ensure would block someone else trying to impersonate me, because I've verified myself with them and I have a means by which to ensure that it's only me accessing my account, for instance. That's in the long term. And in the more immediate term with businesses, they're seeing the value in locking down a strong identity strategy enables them to sell more, to increase conversion, to reduce risk and costs and fraud, and to be able to go global in a lot more effectively. So it becomes a strategic asset as opposed to compliance tick box.
Fantastic. And I suppose finally then, perhaps to wrap up, what will be the final fundamental shift you think is needed in the future of identity?
Back to disruptive innovation. So the disruptive innovation in identity over the long term, over the next 5 years, in my view, fundamentally will go from a centralized, historically credit bureau model to a decentralized consumer-controlled model, where right now there will be a record on a credit bureau with your details on there, and your claim to that is currently your date of birth, name, address. If you're in the US, your social security number, and so on. And that data and those data points are so easy for bad actors to hack and cheat and therefore claim to be you online, and that's slowing down progress in trade and everything else. It means we have to add layer and layer of security, either blocking access from services, or every time you log in, asking you to pick out which of these photos are buses and things of that nature, which is counter to this digital world. It has to be intuitive, it has to be a smooth experience. So identity is broken and getting worse, right? 1 in 3 Americans has been a victim of identity theft. You got up to 5% of the world GDP is laundered money, according to the UN, and less than 1% of that is seized by authorities. So it's broken in excluding half the world's adult population and offering no security for others. So this shift on moving to a decentralized approach is so crucial because you want to offer security and convenience without compromising on privacy. So you can't afford to have another credit bureau or another sort of centralized database model, either controlled by the government or private sector. And because identity is so fundamental and so important, the only option, in our view, is that the consumer needs to own and control their legal identity and be the only provisioner of access to it. And there are a number of different models and partnerships that we have to bring that about, but that is the only realistic way of making it happen.
Well, thank you, Husayn. I think that's about the end of our time today. Massively appreciate you taking the time. I definitely feel like I've learned a lot, and I hope that the people watching in have too. Thank you, everybody from online, for joining us, and we'll speak to you next time.